Welcome back to the deep dive. If you're keeping an eye on the Turkish financial markets, especially pensions and insurance, then Agesa Hayat ve Emeklilik's latest reports are probably on your radar.
Yeah, they definitely should be, but wow, they are dense reads, aren't they?
Absolutely. So today, we're going to try and cut through that. We're looking at their consolidated financials for the first 9 months of 2025. That's January 1st through September 30th.
That's right. And our goal here is really to pull out the key performance changes, understand the pretty incredible growth they've shown, and maybe zero in on some future risks, things like accounting changes that you, as an individual investor, really need to be aware of.
Exactly. We're sifting through all that data for you. And hey, before we jump in, if this kind of breakdown helps you out, do us a quick favor, click like, subscribe, maybe share it with someone else who might find it useful.
Yeah, that'd be great.
Okay, so let's start with the foundation. Who exactly is Agesa? What's their position in the market?
Right, let's unpack that. Agesa, they're a major player headquartered in Ataşehir, Istanbul. Their core business is really focused on three main branches.
Okay.
You've got individual retirement, that's Bireysel Emeklilik, or BES. Then there's life insurance and also personal accident insurance. They're handling huge amounts of customer savings and managing risk.
And your ownership structure, that seems quite stable, right? Gives them a solid footing.
It does, yeah. They are publicly listed, about 19.91% on the Istanbul Stock Exchange. But the actual control, it's jointly managed.
Muçrak Yönetim Tabi, as the report says.
Exactly. It's shared between two big heavyweights, each holding 40%. Agesa's Insurance International NV and Hakkı Sabancı Holding. So, that suggests pretty strong experience backing.
And you can see how that structure might support their ambitions. The reports show they're expanding, right? Particularly into health insurance.
That's a really key strategic move they made in 2025. They actually got the license for the sickness and health insurance branch back on April 30th. Now, as of the end of September, they hadn't started selling products yet, but they're clearly laying the groundwork. You see it in their subsidiaries, too.
How so?
Well, they significantly boosted the capital of Medisa Sigorta, which is their health-focused subsidiary, pumped it up to 1.15 billion Turkish lira earlier in the year.
So investing heavily there.
Yeah.
Before we get into the financials, though, what about the people running the show? Seems like personnel numbers are up quite a bit.
They really are. It looks like they're scaling up, maybe partly for that new health venture. Total staff went from just over 2,000 at the end of 2024
Right.
to 2,232 by September 2025. And what's interesting for investors, perhaps, is the increase in leadership roles. Upper and middle managers jumped from 299 to 352.
Building up the management layer, then.
Seems like it. Handling more complexity, new products lines, that sort of thing.
Okay, now, something that always gets attention. Executive pay. Especially when performance looks strong. Looks like compensation for top execs went up significantly.
It did, yes. For these 9 months of 2025, the total for top execs was 140.6 million TL. Compare that to 93.2 million TL for the same period last year.
That's almost a 50% increase.
Pretty much. It certainly suggests leadership is being rewarded for that big top-line growth and the strategic moves we were just talking about.
But, and maybe this is something we circle back to later, is that rewarding real inflation-adjusted value? Or is it more tied to the nominal growth we see in this kind of economic climate?
That's a really important question. We definitely need to touch on the inflation counting context later on.
Good point. And just quickly, on the topic of leadership, the report's declaration was signed by 7 people and 3 of them were women. So around 43% representation there.
Good to know.
All right, let's pivot. Let's look at the actual performance scorecard, comparing these 9 months of 2025 against 2024. Where do we start? Maybe the core revenue.
Yeah, let's start there. And the growth is, well, it's explosive.
Yeah.
Just looking at the life insurance branch, the written premiums, Brut Yazalan Primler, they surged from about 10 billion TL last year to over 17 billion TL this year. Almost 17.2 billion, actually. That kind of top-line growth is massive, shows real market presence.
And presumably that flowed through to the bottom line. Net profit looked like it more than doubled.
It did, precisely.
Yeah.
Net period profit went from just under 2 billion TL in 9M 2024, 1.989 billion, up to nearly 4.1 billion TL in 9M 2025.
Over a 100% nominal increase.
Exactly. Huge jump in nominal profit.
Okay, now let's dig into the technical side. This can be tricky. If we ignore investment income for a second and just look at general technical balance, kind of the core profitability of the actual insurance and pension operations.
Yeah.
What's that telling us?
Right. This is a crucial metric, and it shows really strong operational success. That general technical balance absolutely soared. It went from 326 million TL in 9M 2024
Right.
to 2.227 billion TL in 9M 2025. That massive acceleration tells you their core underwriting and risk management got a lot more profitable.
Let's break that down a bit, though.
Yeah.
That 2.2 billion, where did it come from? Which segments were the winners?
Good question. So the life technical balance grew strongly from 1.2 billion to 2.8 billion TL. Healthy growth there.
Right.
But the really impressive story, I think, is the non-life segment. They turned that completely around. They went from a loss of 66 million TL last
Oh,
year
nice. Okay.
to a profit of over 600 million TL this period. That points to a huge improvement in how they managed underwriting in that specific area.
Okay. Impressive turnaround.
Yeah.
But then you look at the individual retirement side, the BES technical balance. That stayed negative, and the loss actually got bigger, didn't it? Went from about a negative 830 million to negative 1.2 billion TL.
Yeah.
Why doesn't that negative number worry you?
Yeah, that's a really critical point. For the BES segment, that technical balance is often negative. It's mainly capturing operational costs, things like sales commissions, admin expenses, management fees, relative to the specific income booked in that section.
Huh.
The real money spinner for the BES business isn't necessarily making an underwriting profit there. It's the sheer volume of assets they get to manage. Those assets generate significant, steady investment income elsewhere in the financials.
So the pension side is more about asset gathering, which fuels investment returns rather than technical profit itself.
Exactly. It's structured as an asset volume play, primarily. The technical loss reflects the cost of running that huge operation.
Got it. That makes sense. So let's look at that investment income then. That must be pretty significant given the asset base.
It really is. Total investment income saw a substantial increase. It was up 73%, actually. Rose from 2.8 billion TL in 9M 2024 to 4.85 billion TL in 9M 2025.
Wow.
Yeah, shows they're putting those funds, their own and policyholders, to work effectively, especially in the current interest rate environment.
So strong revenue, strong investment income. How does that translate into actual cash? Is
Yeah.
the company generating solid cash flow from all this activity?
It seems so. The net cash from operating activities grew quite a bit, from 4.8 billion TL up to 8.45 billion TL.
That's robust.
Very robust. It means the growth isn't just on paper, it's translating into real cash coming into the business. And you see that reflected on the balance sheet, too. Their total cash and cash equivalents went up from about 5.9 billion at the end of last year to 8.56 billion by September.
Okay, let's shift gears to the balance sheet itself. The asset number is just huge. Total assets jumped 50% in just 9 months, hitting 405 billion TL.
Can we just pause on that? What does that number actually represent?
Yeah, that's probably the most important thing to clarify for an insurance and pension company like this. That 405 billion TL isn't the company's own money to play with.
Right.
Most of that growth, you'll see it mirrored exactly on the other side of the balance sheet in long-term liabilities. Those reach 346 billion TL. That's essentially the money they owe to the BES participants, the retirement savers.
So the huge asset base is mostly money they're managing for customers, not company profit.
Precisely. It reflects the enormous responsibility they have managing those retirement funds. Okay, so if those huge liabilities are mainly customer funds, what about Agesa's own debt, like bank loans, leases, that kind of thing? How leveraged are they really?
Their actual external financial debt is comparatively very low. It's around 323 million TL in total. For a company managing hundreds of billions, that's tiny.
Very healthy then.
Yeah, very healthy and quite typical for this kind of business. Their main liability focus is managing client money properly, not servicing big corporate loans.
And that strong position lets them build shareholder value, the equity part of the balance sheet. How did that look?
Equity saw strong growth, too, up 58%. It went from 5.44 billion TL at the end of 2024 to 8.60 billion TL by September 2025.
And what drove that increase? Mostly the profit, I assume.
Primarily, yes. That big 4.1 billion TL net profit we talked about was the main engine. Though it's worth noting they also paid out 1 billion TL in dividends during the period, so that offset some of the gain.
Okay. And I noticed they also beefed up their reserves. Extraordinary reserves saw a big jump.
They did. Those reserves increased from about 2.5 billion TL to 4.2 billion TL. That just strengthens their internal cushion, for future growth or any unexpected bumps in the road.
Right, adds resilience. And one last thing on the balance sheet side, they're actively buying back their own shares.
Yes, that's another important signal for investors. They have an active share buyback program. They allocated 640 million TL to it, and it runs until April 2026.
And have they used much of it?
As of September 30th, they'd already bought back about 1.73 million shares, spending roughly 114 million TL. It's a clear sign management thinks the stock is potentially undervalued.
Using company cash to support the share price.
Okay.
Now, part 4. This is where we get into the really critical fine print, the footnotes, the dip not large. We've just seen this massive jump in nominal profit, like 100% plus not, and a 58% rise in equity. But there's a regulatory context here in Turkey that investors absolutely must understand, right?
This is probably the most crucial takeaway, honestly. So first, just for context, the corporate tax rate they're facing is 30% for the main insurance and pension stuff, 25% for the brokerage arm, standard stuff.
Okay.
But the big issue is inflation accounting, or rather, the lack of it. Agesa did not apply TMS 29, the inflation accounting standard, for this 2025 reporting period.
And that was a specific decision by the regulator, SEDDK.
Yes, exactly. The regulator directed them not to apply it for this period.
So why is that so important when we're looking at a 100% jump in nominal profit? What's the catch for us?
Well, the catch is that without TMS 29, those reported profits and asset values aren't adjusted for the high inflation the Turkish economy has been experiencing. So that 4.1 billion TL net profit, it's a real number in nominal terms, but its actual purchasing power, its contribution to equity in constant real terms, it's significantly less.
So the 58% equity growth looks impressive, but might be inflated by, well, inflation.
Pretty much. It makes comparing year over year tricky on a like-for-like basis. You, as the investor, need to view those nominal growth figures with a healthy dose of skepticism regarding the real value increase.
Okay, so inflation distortion is blurring the picture for 2025. But there's another big wave coming next year, right? This TFRS 17 thing.
That's the other huge factor looming. TFRS 17 is the new global standard for accounting for insurance contracts. It's mandatory starting January 1st, 2026, and it replaces the old ways of doing things.
And AG themselves say this is complicated.
Immensely complicated, yes. They've stated it in the report. It fundamentally changes how insurance companies calculate their liabilities, the money set aside for future claims, and how they recognize revenue over time.
So what's the bottom line for investors regarding TFRS 17?
The absolute key takeaway is this. Despite all the work they're doing to prepare, AGS has disclosed that the actual quantitative financial impact, how exactly this will change their reported numbers, their liabilities, their income, their balance sheet, that impact is not yet definitively known.
Wow. So major uncertainty heading into 2026 reporting.
Exactly. You're looking at this amazing nominal performance in 2025, but it's happening right before a potentially massive accounting reset.
Okay, so let's tie this all together. Here's the provocative thought for you, the listener. We've got these great 2025 numbers, but they're distorted by the lack of inflation accounting. And we've got this huge uncertain accounting shift with TFRS 17 coming right up. So how should you value AGSES right now? Can you trust that 100% profit jump?
It means you probably need to shift your focus a bit. While the nominal growth is, eye-catching, the smart approach might be to lean more heavily on metrics that are less affected by accounting rules or inflation noise.
Okay.
Like the operational cash flow. We saw that was really strong, right? 8.45 billion TL. That's tangible cash generated by the business. And also just the sheer continued growth in the assets under management, particularly in the BES segment.
So focus on the cash generation and the scale of the business they manage.
I think that gives you a clearer picture of the underlying health. Aegis's strength seems rooted in its ability to generate real cash and grow the pot of money it manages, maybe more so than the potentially distorted paper profits reported under the current, soon-to-change accounting rules.
That definitely provides some crucial perspective. So to quickly recap, we covered Aegis's strategic push into health, the really impressive operational growth, especially in life and the non-life turnaround, the enormous scale of their customer assets, their very low external debt, and then these really critical warnings about inflation accounting and the upcoming TFRS 17 shift.
Yeah, it paints a picture of a company with significant momentum, but one that's also facing some pretty major regulatory and accounting headwinds, or changes at least. Thanks for diving deep into the numbers with us today.
We really hope this analysis gives you some clarity to help your own investment thinking. If you found this deep dive valuable, please, one last time, hit that like button, subscribe if you haven't, and maybe share it. We'll see you on the next one.